have been also with us in Silicon Valley. Today he will present the iFactor platform. Also here in the room we have his colleague Alin there if you want to talk afterwards with them. So these are the guys. Please, Cosmin.
Hello. Well, I will talk a little bit about iFactor, but basically you'll see I'll try to focus on a keynote actually. It's the first time that I'm doing this keynote, so I expect that you'll have some patience with me and actually give me some support. I am indeed Cosmin Curticapean, and I'm founder and CEO of iFactor. I'm a 43-year-old serial entrepreneur, and I've been built since '95 many businesses. I've never been employed. Have always been a struggle for me to find the right financing for my businesses, and financial crisis from 2008 actually made it even worse. So based on some frustrations that I had in the banking system, I started to build iFactor. Together with Manuel Costescu, JP Morgan senior banker based in London, and Hans Broekhuizen, he was the CRO of Royal Bank of Scotland. Together with my technical co-founders, Sebastian Presecan, Mihai Grosu, and the other guys from the team. Together with our growth manager, Alin Bădiliță, we have built iFactor. I can tell you that it's an alternative SME lending platform, marketplace, where small businesses can gain access to liquidity by selling their outstanding invoices or applying for loans, while banks and investors can bid for these applications. iFactor is a fully automated platform. We use cutting-edge technology. Some of the technologies we use are RPA, DLT, blockchain. We use open banking APIs for our settlement engine. But also we use computer vision, natural language processing, and machine learning from the AI spectrum for the credit risk analysis on alternative data. I don't have a clicker, so that would be because it's with Danny. It also works for the, yeah, okay. As I was telling you, we started with a problem. The problem we found in the financial industry, financial services industry, was this SME lending hardness. I can tell you that over 90% of the SMEs worldwide have insufficient access to funding. Still, 4 out of 5 new jobs are created by the small businesses, but they are still looked and considered small ticket size by the banks. Banks, on the other hand, face unreliable credit data for their credit scoring analysis. Yeah, I guess we are an InnovX scale-up graduate, so we'll talk about innovation. So what I would like to talk about further on is how we leverage the non-financial data, the alternative data, to improve the scorings that we use based on historical financial data. And in order to do that, I would like to make, for the guys in the room that are not necessarily technical with the financial services, I will make a small recap of what financial services landscape looks today. So we talk about the services, paying for goods and services. We can talk about the second category, which is moving the money from today to tomorrow, which means the savings and investments. We can talk about moving the money from tomorrow to today, which are the credit, the loans. And we can talk about managing the risk. All this stuff is based on decision support. All this stuff is then based on the infrastructure that further on is played with the rules of the games. And the rules of the games are the regulations, the laws, and the compliance. Well, the innovation in the financial services is based on technology, and the infrastructure was changed as a result of the technologies. At the intersection of the financial crisis in 2008 and the rise of the new cutting-edge technologies, we could see a newborn industry, which is the FinTech. So technologies that underpin the innovation in financial services include cloud computing, so the cloud computing, DLT, which means the blockchain, but the technology, not the crypto assets. We talk about mobile and internet, RPA, APIs, and nevertheless, artificial intelligence and big data. So we have made a recap on the financial services. So I'd like also to make a recap on how artificial intelligence and machine learning are defined and how do they basically differ. When we talk about artificial intelligence, is typically defined as the ability of a machine to perform cognitive functions that are usually associated with human mind. On the other hand, the machine learning is the way machine learning algorithms detect patterns and learn how to make predictions and recommendations based on large amount of data. And that being said, we are narrowing a little bit more down now towards how machine learning and big data and analytics were enabling financial services since 2015 to now. So we can see on the investment and advice, we can see that decision support, the savings, the borrowings, and managing the risk were very highly influenced. On the RegTech and fraud detection, we can talk about being influenced to services of savings, borrowing, payment, and managing the risk. Asset trading, saving, borrowing, managing the risk. And I will narrow it more down now to the credit decision where we have the borrowing and managing the risk. What is a credit? It's very simple. A bank or a lender gives a loan to a customer, which is the borrower, and then it's expecting on returning the money and an interest based on the return. But now, what and how does and why does somebody need the credit scoring, the credit risk scoring? Well, if we take the examples of the bank, it's simple that we can look at how they are trying to maximize the return for a calculated level of credit risk, or on the other hand, how they want to minimize the credit risk, how they want to minimize the credit risk on a required level of return. So the credit worthiness, it's one thing that everybody is looking when it's giving a loan, because that loan has to be repaid. So in order to do that, we have to look to the five C's, which are the attributes of the credit scoring. But I will not talk very much about them. I will only talk about the character and the capacity, because this is mainly what it's all about in the credit worthiness. And when we talk about alternative data and the technologies that enable the alternative data and the big data into the financial services, we see that in the credit scoring, we look at two patterns: the ability to pay, so the capacity, the solvency, the capacity to repay the loan, and the willingness to pay, which is the intention to repay those money. Douglas Merrill said the former CIO of Google said for the New York Times that all data is credit data. And at iFactor we cannot agree more. Because when we look at the patterns of the historical financial data, we see that traditional credit risk models use the past loan performance to extrapolate in the future performance trends. What does it mean? And why actually this is negatively impacting, or why doesn't actually reach to the customers? Why over 90% of the SMEs have insufficient access to funding, to debt funding? It's because the banks use the way of looking to the mirror to see how the companies were performing, and then they are trying to extrapolate and look if they can reach the top of the hill, which is good, but not good enough when you have in your hands very good technology. Therefore, The alternative credit models use vast quantity of diverse type of information to predict behavior factors that might influence the future performance, which means that we can have answers in real time, and we can eliminate false negatives and false positives. And some of the alternative non-financial data analysis is based on some, and how we use it in iFactor is very simple. We use information from the social media, digital footprint, mobile phone usage, and psychometry. And nevertheless, lately, based on this new legislation of PSD2, we are able to map and overlap some of the alternative information with very interesting dashboards of traditional behavior. I will only make now a small parallel of how traditional data is used by the banks, and for that I want to talk about the credit cycle. Usually the credit cycle is based on 5 steps: product design, credit analysis, monitoring, and loan repayment. In the product design, the design of lending products is constantly changing process due to different sectors and geographies. Because of that, using the traditional data, well, I guess it's something switched off here, Alin. Basically, he was using the whole alternative data for the traditional data. So we'll go here. So based on the industry point in time, geography, credit metrics, and are influenced by compliance, regulations, legislation, and business culture. What does this mean? That always the banks have to work a lot to expensive products in order to adjust all the time to the new realities. While if we go back, and this is the alternative data, if you unbundle the SME lending products, for example, lending, then you can end up on having one type of category of lending product for SMEs that would adjust in real time based on recommendation engines which are analyzing the market and characteristics. Don't get me wrong, the banks actually do that all the time. But because they are very heavy, big animals, it's very, very hard to actually be able to implement into the market all this stuff. And the costs of doing that, it's usually extremely high. When we talk about the credit analysis, we have the quantity, quality of analysis, documentation, and legal aspects. All of this stuff, when we talk about the traditional data, we go on the credit analysis. For example, the quantitative analysis is based on historical data, and which is very bureaucratic. When we talk about the qualitative analysis, it's face-to-face interviews, field visits, manual scrapping of databases, traditionally speaking. When we talk about the documentation, usually it's manually done by hundreds of lawyers, legal departments, risk departments and stuff, and at the end, it ends up with huge costs. And then collaterals collection in case of defaults, and that just jumps off the roof, everything. When we talk about the monitoring, the customer friction with regular reports, interviews, and bureaucracies. So if I'm an SME and I am applying for a loan, it's right now tough enough. But then during the lifetime of that loan, I still have to be in contact with the bank and give all my reports. When we talk about alternative, we can see here that we can use analytical dashboards based on traditional and alternative data, including the account information from PSD2. When we talk about the quality, we can talk about the alternative, and I will expect questions from you after my keynote, about social media, digital footprint, telecom, mobility, psychometrics. When we talk about documentation, we use automated robotic process automation for the documentation. And when we talk about monitoring, we have real-time analytics based on entrepreneur, business, and macro environment. So with this being said, I'm curious if you guys have any questions. And I'm glad to give you some examples of how properly this can be used in different.
So we'll have, I think, one question, just to whom it is, Delia.
Thank you. A very nice presentation, and thank you for that. I'm Delia, and I work in banking system in making products for companies which are exactly loans. So I perfectly understand what you're saying. My first question, first of all, I really like your idea and your solution. Of course, banking system is very old, and we still use quite a lot of historical data. But what historical data says, that the most predictive part of how a customer will repay is his previous repayment capacity. So in history, if you saw that he repaid the loan, then you have the biggest chances of him repaying further loans. So until now, this methodology, even if it's old and we look in old system, it works. Why do you think that this new approach of yours will have a higher Gini score, and do you consider that this new data will better predict future repayments?
Well, to start with the answer, we just go to the statistics, and once again, less than 10% of the SMEs are actually serviced by the banks. And the reason for that is that only less than 10% of the SMEs have traditional and historical data reliable for the banks. This is one thing. The second thing is that in order to fit the bank's requirements, the SMEs need to have the capacity of financial management, to have a CFO, to have maybe some knowledge about cash flows, about budgets, and how to build that business and the financial historical data. And then, of course, if they perform very well, then the banks will help them. Problem is, and once again I'm going back, 4 out of 5 new jobs are created by the SMEs worldwide, and half of the GDP of the world is built. It's built by and growth by these small businesses. In Romania, for example, we have 700,000 companies, more or less, and around 50,000 are the core of which are banks are only addressing to 50,000 of them as lending products. What about the others? So the others are either small companies with unreliable scoring data, so they import a lot from the risk profile of the entrepreneur, which is in the front of the company, forefront, or, for example, they are very new, like 1 year or 2 years. And then what do you do with those? Because basically these entrepreneurs, they are growing their businesses based on the industry expertise, based on many other directions. Therefore, when you have a way to balance the traditional way the financial products were built, then you are able to eliminate the false positives and false negatives. What do I mean with that? A lot of companies, when they want to get a loan, if they have some expertise in the financial management, then they will settle all the documentation in such a way that they will gain that loan. And probably you already know, because of the statistics, some of them, they are not solvable actually. They only look nice, but and this is a false positive, when that company gets a loan, but it shouldn't get it. On the other hand, you have the biggest part, which is false negatives, where small companies should have a loan, not guaranteed loan, and then they don't because the ticket size is too small. The cost for underwriting and analyzing the documents is very high. Plus, if the data is unreliable, the banks cannot give these loans to these companies. And this is the most of them, the biggest part of in numbers. And this is how, by doing this alternation between historical data and predictions based on thousands of data points. I mean, for example, if is coming an entrepreneur and is asking, I don't know, a leasing or whatever type of product you'd like, and he wants to buy a car, you cannot see that he's gambling or although he's performing well. But then, if the company is under 500,000 euro turnover, the risk is very high. So probably the cost of that loan is very high, or you will not hand it to this entrepreneur. But then we can see also what kind of school he has, how people from that perspective were performing in their industries and stuff. So it's Well, anyhow, everything is at a very incipient moment. In this moment, it's a start. It's a prehistorical, let's say, point in time where we are trying to build that. We are not saying that the architecture that we are building it will be the biggest success. But what we are saying is that by having this kind of principles, it's actually much healthier to build the future of the SME lending products.
Thank you very much, Cosmin. Let's give them a big round of applause. We have to stick on the schedule, so
Thank you very much.
can have Cosmin after that.